Next up, I have the pleasure of hosting a fireside chat with the management team of Valmont Industries. Valmont is a diversified producer of products and services for infrastructure and agricultural markets. The company operates through the two segments, infrastructure and agriculture. Joining us today from Valmont is CEO Steve Kaniewski and Treasurer and Senior Vice President of Investor Relations, Renee Campbell. Steve was named CEO of Valmont in December 2017 after first serving as COO. He originally joined the company in 2010 from Belden, where he was Vice President of the Specialty Division. Renee was appointed Treasurer and Senior Vice President of Investor Relations in February 2022 after first joining Valmont in September 2017 as Director of Investor Relations. She previously served as Director of Corporate Treasury at Intrado, formerly West Corporation, and Vice President of Global Cash Operations at ACI Worldwide. Valmont has 21 million shares outstanding. The stock trades around $284, $6 billion market cap, $825 million net debt, $6.8 billion total enterprise value. Steve and Renee, thank you very much for joining us.
Thank you.
I'll lead off our fireside chat, and then we'll be happy to take any questions from the audience. I mentioned in the discussion with Lindsay Corporation, the IIJA, I probably failed to define that, the Infrastructure Investment and Jobs Act. We've also had the IRA, Inflation Reduction Act, federal stimulus packages in the U.S. Can you help explain how those two major federal programs impact and benefit the products and services you have across the different pieces of your business?
Sure. So both of those acts basically touch every single one of our product lines. And so it really gives a nice long-term view, really a decade view for both states and federal highway funds to make it to the market, if you take the IIJA. And then the Inflation Reduction Act is really targeting the transmission grid, solar opportunities that we play in. If you look at the way that stimulus has been done, let's say for the past 15 years, there was no long-term infrastructure act in place. And so states who still burden 75% of the spend would do one-year projects. Anything that was 1 year, if you think of Mint and Concrete, that was what they did. Doing interchanges, doing big new highways, bridges, things that took multi-year, they tended to demur from them unless they were in really, really critical condition. So for us, much more of our high margin products come from those interchanges, bridges, highways, as opposed to just a resurfacing project. If you think of the engineering that we do on, let's say, a high mast pole, high mast is one of those lights at an interchange that is way high with multiple lights on it, typically has a raise and lowering system that goes with it. So we tend to have higher margin products that come about with those kinds of projects. In the case of the IRA, it really will help to stimulate the energy transition and help support U.S. manufacturers in that opportunity. If you've seen the New York Times just yesterday, they talked about the need for 47,000 gigawatt miles to support the transition by 2035. If that was the case, our business we would probably be 3x under capacity. So that'll go through regulatory hurdles, that'll have a lot of issues, but the demand will be there. If you think about the old way of doing generation, you had a 1 gig coal or maybe natural gas plant, and it had a single substation there, another substation when it hooked up, and a single line. Now with all these distributed generations that are going on, 100 megawatts here, 50 megawatts there, all of that still has to get back to the grid, and all of it needs substations on both ends. And so that really is a long-term stimulus for us. We see our infrastructure business as the overdrive of our growth, with the ag piece having been kind of the initial turbo to get things rolling. But ultimately, you're touching rural broadband connectivity. Our telecom business touches that, solar, transmission, distribution, and substation, and then obviously lighting and transportation. So all of those are just really good long-term views for us. And as we look at capacity and capital allocation, gives us a lot more of a roadmap as we look forward.
Excellent. And we covered some of this already, but within your infrastructure portfolio, which is comprised of the numerous different business lines, can you help us think about the funding sources, which we've already kind of touched on, for these projects that keeps them somewhat insulated from external financing market dislocations or further economic softening we may see this year?
Sure. I'll start with telecom. Telecom being top of mind when it comes to 5G and the 5G rollout. There's so much investment that's already been done just in the spectrum that they have to get this deployed. They initially went after coverage, which is why many of you will see 5G on your phone, but then you'll be pretty frustrated with the bandwidth that it brings or the fact that it won't refresh as quick as the old LTE was. That's because of density. So the initial part of this was all about coverage to meet government requirements. And now the funding that's going in there by the carriers, by utility players, there's a lot of different people coming into the telecom space, and it's because of the densification of antennas. You need almost 10x more antennas than we had with LTE. And they're going to be in small sites, integrated poles. If you think of a lighting pole that has a big fat top on it, that's the antenna. That is our business. And our recent acquisition with Conceal Fab, which was a joint venture with Ericsson, really brings us into that piece of it. On the transmission distribution side, those are typically private utilities, some public utilities, and a little bit of stimulus money. In the scheme of things, $70 billion would be great, but as compared to the trillions that are being spent, it's not as much because transmission already has very attractive return on equities of between 10 and 13%. And so the more transmission that gets put into place, the more those owners benefit from that annual return on equity. And then as we talked about with lighting and transportation, 75% of that is in the US is burdened by the states and about 25% federal. And many states, because of the COVID relief funds, their balance sheets, quote unquote, which they don't really have, but they didn't have to cut infrastructure spending to compensate for social spending. And so that really allowed things to continue to move through the funnel. If you go to Western Europe, there was a lot of government incentive. In India, they're building 20 kilometers of road per day. And in Australia, which is a big market for us, there's a number of public-private partnerships in place to address infrastructure. So whether it's the developing world that needs new infrastructure or the developed world that needs to renew it, there's funding coming into all those sources.
Excellent. And Valmont's solar business has been a standout in terms of growth. I guess, can you talk about the prospects you see for continued growth in that offering, both as a standalone and in conjunction with other parts of the Valmont portfolio?
Sure. So solar for us was a natural extension of our utility business. And so in 2018, we purchased a company that made the tracker, the piece that helps follow the sun, on a single axis from Italy, from Convert Italia in 2018. We originally had the thesis that we could take it into our utility customers here in the US and offer it there. They were already in, as you can imagine, Europe, North Africa, and also Brazil. That geographic diversity really helped us as solar kind of stopped and started in the US, whether that was the FTC with the module and chip, anti-dumping kind of efforts that were in place. So utility scale in the US kind of has had fits and starts. What has done very well for us, and this was a conscious decision by us, was to go to distributed generation. Distributed generation takes a little bit more SG&A. If you don't have tools in place, we do. So we already had tools that we could adapt from both our irrigation business and our utility business so that we could pump out more quotes for less megawatts, but it brought a stability to the revenue, and it probably was 10 points higher on the gross margin side because you're doing a lot more work for the developer. We had initial success there, and it was in 2020 where we acquired a small ag solar player in Brazil. And if you think about agricultural land, farmers that are off-grid, or at least where the grid is challenged, interruptible power, that was for us also a natural extension. And that's in it rolls up into our agriculture segment. And our ag solar business in the last 18 months went from basically $1 million or two to almost $100 million run rate. And it came from the fact that growers around the world are being pushed on ESG, on using less to produce their food. If you think of Mato Grosso in Brazil, which is to the west, there's no electrical infrastructure. It is the hinterland in Brazil, but it has a replenishing aquifer and is really starting to grow corn and things like that. Again, as opposed to a gen set with a diesel generator to run your pumps and pivots, we could offer it as a standalone solution. And so we touch all of those, and because we can play with the geographies, it's allowed us to avoid some of the bad market behavior and also the ups and downs. So we can go to Brazil one year, we can go to Europe another year with more emphasis, depending on where the projects are actually being let and the developers see a clear line of sight.
Excellent. Also on the agricultural side of the portfolio, recently had a nice win, large Africa project, $85 million award. I guess, can you talk, maybe already touched on it, but some of the mega trends driving those projects, particularly in international markets. And do you see any pause or interruption to that project momentum in light of tougher financing markets?
I'll touch the financing piece first. The strong US dollar can always inhibit large projects for us. Everything we do is denominated in USD. We seek confirmed letters of credit on these large projects to mitigate risk. So as countries have to produce dollars if their local currency has weakened, that's a constant issue, and I would say is baked into the pipeline all the time. So that's not as big of a concern for us. It may affect timing, but doesn't really change the pipeline. If you take our recent previous to this, we did a $240 million project in Egypt. And Egypt was all about political stability. And it came off of the Russia-Ukraine crisis. When the Arab Spring happened, it was because they raised the price of bread 1 cent. And with a growing population, with a lot of younger population in areas, discontent can brew very quickly. President al-Sisi visited our site 3 separate times. And took pride in the fact that this was the largest single irrigation project ever done on Earth. It's twice the size of Los Angeles in the south of Egypt. And those size projects never happened in the past. It was always maybe a $10 to $30 million type of project. Now you have 85, 240, the scale of which is really changed. And that is a direct correlation to food security. If you came out of COVID, now there's geopolitical risk. And really the whole realignment of supply chain because of the BRICS is changing that scheme too. So long way to answer your question, but the pipeline is strong. And it's strong in Eastern Europe, Central Asia, Africa, amongst other places.
Excellent. I'll see if there's any questions from the audience at this point. Again, if you have a question, feel free to raise your hand.
On your electric grid, how is your business affected by the U.S. grid system so fractured, so distributed? Are you a beneficiary of that, or does that really negatively affect your business being able to transport power seamlessly across the U.S.?
So for 2 decades, we were seeing conservation with no load growth in the U.S. And one of the drivers was the interconnection of the grid. So getting the points connected to the grids was actually a stimulus to our business. There's a move afoot to really try and take the regional transmission operators and connect them all together so that when there's a surplus, you can transmit it further. So that was one thing that we were doing it was a good driver to the market. The other was just the fact that most of the infrastructure and transmission was 60 plus years old. A lot of it was wood-based, and as you know, from a grid hardening perspective, if you look at Florida, California, Texas, anywhere in the Southeast, hurricanes, forest fires, seismic events, you have to replace these things. We replaced a line in New Jersey just last year. It was an 80-year-old transmission, wood transmission, and it was the #1 source of power for Manhattan, right? So that was already occurring. The new stimulus is the fact that load is now going up, and it's because we're electrifying everything. And the more that there is electrification, the more political outages have become, right? Governors are on TV after 6 hours having to talk about why power's out. And if we electrify everything in a person's home, including their car, and power goes out, that will be a problem. So the interconnection will take place even at a more robust level. Plus, you have to meet all this growing need for electricity. That's why I use the term overdrive. The targets that are out there for renewables by 2035 won't occur without transmission. I think Europe demonstrated that coming off the Russia crisis. You can have all the generation in the world, if you can't distribute it around the continent, it doesn't do you much good.
Excellent. Wanted to shift back to discussion on the agricultural side. You've spoken about Brazil. The business has been performing very well there. I think you even alluded to potentially that being larger than the North America business. What are you seeing in terms of uptake for technological adoption from some of your ag tech offerings there? And I guess what approach do you have in market to test some of your cutting edge technology there?
Yeah, so Brazil for us, we've doubled each of the past 3 years. And it's come from a combination of sources. Soy obviously has stayed very high, and soy is now used as a fuel for biodiesel. So just like ethanol was a stimulus for corn, soy now is being propped up by biodiesel. It's a market that we know will pass the U.S. in terms of agricultural production in the next decade. And for us, our international business is almost on par with our North American business in agriculture now. So when we come to technological solutions, and whether it's our Prospera Insights product, AgSense, any of that, we test in North America, but we simultaneously test in Brazil. We added over 30 dealers. We used to have 12. We have 42 dealers now. Most of those new dealers are very tech friendly. They want tech. The Brazilian farms are of scale, 20, 30, 40,000 hectares. They operate like large food producers here in the U.S. So if they see an investment that will save them on inputs and increase yield, they're more than willing to adopt, in some cases faster than even here in North America. So we go down to Brazil on a regular basis to try all of our technology. And we've recently upped our tech resources in country to support, because the pull has been very strong. So we feel very good about Brazil from a technology adoption. From just an irrigation adoption, they also put on pivots quicker than here in the U.S. They have 2 grow seasons. If you put a pivot, you get 3. So the payback is very strong in Brazil, and take that swath across the world. You can go Peru, all of North Africa. If you can get multiple crops because you can time the growth with the pivot, then you're going to adopt quicker. So we see new land development in Brazil, 40% of the time they're putting a pivot on, versus maybe 20%, 25% here in the U.S.
We talked about the technology you're incorporating into your product offering. You've also been making a number of technology investments into your own 4 walls. Can you talk about some of those and what they've unlocked from a capacity as well as productivity standpoint?
Yeah, we've always had a very strong lean orientation, and squeezing out as much of our brick and mortar as we possibly can. Running 3P events to find space so we can put more fit weld kind of stations in there. But with the labor shortages, particularly last year, it really forced us to look at some of our investments and to say we're going to take a bet or two on some new technologies. There's been robotic welding for a number of years on spec products, things that you make over and over and over again. Our products are engineered. Each product, you could look at a line of transmission poles and they may look the same to you. The soil underneath is different. Some are direct embed, some are base plated and tied down to an anchor bolt. It's very different as you go in the ground, and so the thicknesses, the heights of all those to make them look perfect are very different. When you go into production, the issue is you have every product different. So we actually have worked with a couple of companies on with machine learning to actually do autonomous welding. So it can look at it and make the number of passes, make the welds per product. And those kinds of cells are like $1 million a pop. But it really gets the welders who are hard to come by to do more value-added work. So if you think of something that has to pass 7 times on a 3-foot diameter pole, it's pretty boring to just stand there and go. So this can help bring that autonomous operation for us in our factories. And it's helped unlock things there with material movement. We've spent a lot of time just where is everything? And so even RFID now is passé. There's new technologies there that we're utilizing. We can tell customers in our galvanizing business exactly where all their product is, how long it's been sitting, so we can make calls to get them in. All of those help material flow. And with the expansion in the business, the amount of area you have to lay down products that are finished and waiting for pickup really becomes tight. And so we've spent a lot on just material movement and those kinds of things. And obviously, I mentioned the quoting tools, the drafting tools, the engineering tools. We're using AI across the board there. And we've been using in our irrigation group since 2013 a proprietary AI for supply chain decisions to figure out when we do these large projects, how much is going to come from each plant based on currency, based on tariffs, based on time to market, based on cost. So that's already been something we've been utilizing for quite a while.
Yes.
I don't know if I'm getting the right impression, but it sounds like your business is becoming more sophisticated. Will it also become much more capital intensive? Could you talk a little bit about how that will develop over the next few years?
You want to touch it?
Yeah, so the short answer is yes. And I'll make a pitch for the Investor Day that we're hosting in a couple of weeks on May 23rd at the Stock Exchange. And we'll also do it virtually. But you will see, we will talk about how as our business is growing, we are going to look at ways and we'll be increasing our capital expenditures to include more around digitization and technology type of investments, both in our facilities and also to be able to serve our customers in a better way as well. So our capital allocation framework and strategy really hasn't changed in the sense that we still strive to be fairly balanced across the board between reinvesting in ourselves as well as M&A opportunities, and then returning cash to shareholders through buybacks and dividends. But capital spending is kind of first and foremost how we look at investing in ourselves, knowing that we have such market demand, strong market demand over the next several years across all of our businesses. So we're being very intentional, and even this year have indicated that spending would be higher. As Steve mentioned, we're putting automation, Industry 4.0 in a lot of our facilities. We have been expanding even some brick and mortar within existing facilities to serve demand, as in Brazil. We have a facility in Dubai it's in a tax-free zone. It's a great location to be able to serve the Middle East and Africa markets for irrigation. So the short answer is yes, we are putting more sophistication and digitization into our facilities, but also across the board in terms of products and solutions to our customers, which also is part of our CapEx strategy.
but it has helped us. If you look at last year, we did a step function on our return on invested capital from 10% to 13%. And so, we monitor payback very closely and where we go, and it is paying off for us, both between volume leverage that we're gaining through the existing brick and mortar, better machine utilization, and obviously labor utilization, particularly when it's tight.
You have the advantageous balance sheet, long-term fixed rate notes, just 1.5 times net leverage to support the organic and inorganic investment. Can you help us think about, what geographies or product lines or mostly technology bolt-ons you might focus on from an external investment standpoint?
Yeah, sure. So when we think about M&A opportunities, we have a solid pipeline in place today, and we kind of have a few strategic filters that we use to view those through. We look at capability expansion. So I'll use ConcealFab, the telecom, the joint venture with Ericsson that Steve mentioned earlier. We're already in the telecom space, but what the ConcealFab group was able to offer was something called passive intermodular mitigation, or PIM mitigation, which is to help address the issue that happens when you have frequencies that commingle. So it was a capability that we did not have, that they were very good at doing, but it was a natural fit into the telecom business that we do have. And then, of course, the partnership with Ericsson allows us to expand into potentially other geographies or other markets. The other filter that we think about is a technology capability enhancement or expansion, as you've seen with our Prospera acquisition a couple of years ago, which Steve touched on. We also think about literally geographic expansion in high growth market areas or high growth businesses for us. So you'll hear us talk at our Investor Day about what we're doing to increase aftermarket parts, for example, in our irrigation business. That's a real growth, reoccurring revenue opportunity for us. We've had a robust parts business for many years, but we're being very intentional about how we are going to grow that over the next 5 years, which could come by way of an acquisition target.
Excellent. Maybe with the ConcealFab acquisition, can you talk about what the response has been from your existing customer base from incorporating this new solution for them?
Yeah, and once the densification starts to happen, this is a critical component of it. It sounds techy, PIM, but if you just think of a mix of materials can actually wipe out a signal. So if you have the zinc from the galvanizing competing with the plastic that's on the site, you could lose the signal strength by a factor of 50, 60%. And so our customers are highly attuned to this, and that's one of the reasons they really liked this acquisition, is it gave us the capability as the provider of the structures to begin with to do more of this. For us, it also changed our customer concentration, and we were able to get into a lot of new customers that we previously had done a little bit of work but never really had made the inroads into it. When you're associated with Ericsson, who at least right now is the #1 antenna provider in the US and much of Western Europe, basically anywhere Huawei is blacklisted, it really also opens up OEM opportunities with them. They didn't want to go geography by geography trying to figure out a pole manufacturer in Eastern Europe, Middle East, India. And so that gives them the ability to utilize just us all around the globe with our plant structure. And so that was also a win-win in that case. So it's been received very favorably. And as the densification takes place and you're really hiding antennas on buildings in different types of structures, that's the key.
We have a question.
I wanted to ask, what percentage of your business is annuity-based today or growing into an annuity-based model in the future?
So right now it's still a very small piece of it. We've said that we doubled our recurring revenue last year through some deliberate efforts, albeit on a small number. We want to target, and we have very good line of sight to get to $100 million in each of our businesses of recurring revenue, whether it's the infrastructure side or the ag side. And as an industrial, it's a huge cultural shift to go from selling products to services. But between the acquisitions we've done and the areas that we've gone after, they're natural extensions to do that. You know, the remote telemetry was our real first foray into that, of turning a pivot on and off remotely. You sign up with a credit card, it hits the balance, you know, you just run it every year. Retention rates are well over 90%. Our Insights product is a full recurring revenue model. We've seen 95% retention on that particular offering, and we're moving into some inspection services within the infrastructure area via drones that we're the natural to go there, and that's recurring. Now, Renee mentioned parts. You will get parts every year. It's recurring in nature, but it's not true recurring revenue. But we've made really good strides in that area.
Yeah, and it's a deliberate strategy for us because we know that there is some cyclicality in some of our businesses. So the more that we can intentionally focus on and grow that recurring revenue base, the more it will help mitigate some of the, you know, call it the ag cyclicality that we've all experienced over the last, you know, decades, several decades.
And with the ebbs and flows we've seen in input cost inflation, you know, over the last year and a half, can you help us think about how you've managed pricing across the various businesses in the Valmont portfolio?
Yeah, so first and foremost, I'm a pricing advantage adherent. So I believe you have to always do value-based pricing. So when I took over in 18, well, I can even go back when I ran our utility group, I was raising price even though the market was going down. Because it's hard work to do, it's expensive work to do, and we were the leader in the market and not commanding the price we needed. If it took losing some volume for a while, so be it. In 18, when I took over, we went really after our lighting and traffic business, which at the time was probably in the mid-single digits in terms of operating margins, and now is one of our best performers. So we started kind of before inflation hit. So I think we were in a much better cultural standpoint that when it did, we were quick. So we could see the futures market, we could see where things were going with steel, aluminum, zinc. We saw what was happening with labor, and we went out proactively, and that's why we were able to have incredible years, even despite the inflationary environment, not because of it. Some companies have benefited because of it. I think we did benefited because it really forced our competitors to get onto the price bandwagon as well. And as inflation has moved up and down with particularly raw materials, we've not moved back on price. There's no need. Demand is incredibly strong in all of our markets. And you know, last I checked, supply demand is the #1 price determinant. So we're not going to change just because raw material costs have moved down. There's so many other inflationary items in our business with labor, healthcare, transport, energy, et cetera. And I think, unlike consumer goods that may have a little bit more of a whipsaw effect, everything in our business has.
And I would just add, you know, Steve, give yourself some credit too with your pricing advantage adherence. It's also about pricing for value. And, you know, there are some critical areas that our customers really value that we can deliver that in many cases our competitors can, or certainly not as well as we can. For example, if you've got a large construction job, a utility line that's going in, on-time delivery of our product, because it is one of the last things to go into that project, is very, very critical because time is money. So we have developed a reputation in the market for being that type of supplier. Same thing with any kind of a highway project or intersection or traffic signal. Time is money. It could be quality related. Our ag products as well as our infrastructure products, highly engineered, very high quality standards. So the pricing, I guess, philosophy and culture that Steve and we have developed as a company is really also about what we bring to the market, what we bring to the customer, which really helps with that stickiness.
Terrific. If there's no questions further from the audience, then we will conclude there. Steve and Renee, thank you so much for joining us today.
Thank you.
Thanks, Brett. Thank you.